All right, today we're going to walk through what I like to call the investor's minefield. And let's be honest, that's what it feels like sometimes, right? It's a landscape just packed with hype, a ton of noise, and some really well-hidden dangers. But by the end of this, I promise you'll have a solid framework to not just survive it all, but to actually thrive. We're going to talk about managing risk and building real, lasting wealth. So let's dive in.
I want to start with a question that I think gets right to the heart of what keeps a lot of investors up at night. Are you really safe when you feel the most secure? It's a weird paradox, isn't it? So many of us think our 401ks and our diversified mutual funds are like this impenetrable fortress. But as we're about to see, sometimes the most dangerous place you can be is in a false sense of security.
I mean, just look around. On one side, you have this just incredible, unbelievable hype. You see these projections, right? Global AI spending is going to soar past $2 trillion. You hear these wild stories of crypto millionaires. You see tech stocks with valuations that seem to defy the laws of physics. But then, on the other side of the coin, you've got these seasoned, veteran analysts screaming from the rooftops about an extreme bubble. And we've all heard those horror stories of lottery winners who get millions only to end up completely broke because they had no clue how to manage their assets. This is the minefield we're going to map out together.
So, how are we going to do it? Here's our roadmap. First, we'll tackle the modern investor's dilemma and totally redefine what a financial foundation looks like. Then, we're going to open up the investor's toolkit and learn how to spot those hidden risks. After that, it's all about mastering our inner game, our psychology, so we can finally build what's called an anti-fragile future.
Okay, first things first. We have got to completely rewire how we think about wealth. The old model, it's broken. It is not about your paycheck. It is all about your portfolio. It's not how much money you make, it's about how much money you keep, and maybe even more important, how hard that money is working for you.
And this quote from Robert Kiyosaki, this is the cornerstone of this entire idea. You have to shift your primary focus away from your next pay raise and onto your next asset acquisition. That mental leap is everything. It's how you go from being financially fragile to having real financial freedom. Your income, that's temporary. Your assets, that's what builds wealth that lasts.
And this slide just lays it out perfectly, the two different paths you can take. Over on the left, you've got the employee mindset. It's all about trading your time for money, thinking about pay raises, benefits, job security. It's kind of like running on a hamster wheel. But on the right, you've got the investor mindset, which focuses on a totally different set of metrics: cash flow from your assets, the growth of your portfolio, and true financial independence. See, one mindset makes you a cog in a machine. The other makes you the owner of the whole machine.
So let's build on that. Once you've got the right mindset, you need the right tools. But here's the crucial point, and you got to get this. The most powerful tools in finance, they're not for gambling. They're not for wild speculation. Professionals use them like a surgeon's scalpel to manage and control risk. And today, we're going to look at options as the perfect example. Options are maybe one of the most misunderstood tools out there. So let's just demystify this thing right now. An option is not some crazy complex bet. At its core, it's just an agreement that gives you control. It's the power of choice. You pay a small fee, it's called a premium, to lock in the choice to do something. But here's the magic word: without the obligation to actually do it. And that distinction, that little difference, changes everything.
Okay, let's see this in the real world with the jet fuel analogy. So, step one, the problem. Airlines have to deal with these insanely unpredictable fuel costs that can absolutely wreck their profits. Step two, the tool. So what do? They buy an option. They pay that small premium to lock in the choice to buy fuel at a set price down the road. Okay, now step three, price goes up. If oil prices skyrocket, no problem. They just exercise their option, buy fuel at that lower, locked-in price, and save millions. But what about step four, price goes down? Well, if the price of oil crashes, they just let the option expire. They lose that small premium, and then they go buy all the fuel they need at the new, super cheap market price. It is literally a win-win situation.
Do you see the beauty in that? They win no matter which way the price goes. They've taken this huge, terrifying, unpredictable risk and turned it into a controlled, calculated business decision. They aren't trying to predict the price of oil. They're simply controlling their exposure to it. That is the power of using professional tools the right way.
So we have the right mindset. We've got the right tools. But what about the risks we can't even see coming? Well, this brings us to a concept that I find absolutely fascinating. It's called the turkey problem, and it is a powerful, powerful analogy for understanding the most dangerous kind of risk there is.
Just imagine for a second that you're a turkey living on a farm.
Every single day, for 1,000 days straight, this friendly human shows up and gives you delicious food. He protects you with a sturdy fence. Your life is safe, it's comfortable, it's predictable. And with every single passing day, your confidence grows. I mean, your data set is 1,000 points long, and every single one confirms your belief. These two-legged creatures are clearly your benevolent protectors.
And then, on day 1001, the pattern catastrophically breaks. This, my friends, is a black swan event. It's a risk that was completely invisible based on all your past experience, right up until the moment it destroys you. For an investor, a long bull market can feel exactly like being that turkey. Every single day just reinforces that feeling of safety and certainty right before the unforeseen event comes along and changes absolutely everything.
So, what do these Thanksgiving surprises look like in the real world? Well, first, you've got political risk. Think of a sudden trade war that just cripples an industry you're invested in. Then there's technological risk. I mean, Blockbuster Video felt pretty safe and secure until a little company called Netflix showed up. Systemic risk is that market-wide meltdown, like in 2008, that basically takes everyone down with it. And finally, there's a risk we all hope to have, longevity risk, the very real danger of actually outliving your money.
And to really drive home this point about needing to understand the specific risks in any industry, here's a classic quote from the legendary Charlie Munger. Now, it's a little cynical, I'll give you that, but it is a powerful reminder. You have to approach every single investment with a healthy dose of skepticism. You have to deeply understand what can go wrong, especially when someone is promising you the world.
Okay, so we've talked about mindset, tools, and all these external risks. But honestly, the most important factor in your long-term success might just be your own psychology. Mastering your inner game is what separates the amateurs from the pros. It's not about being the smartest person in the room, it's about being the most disciplined.
You know, one of the biggest psychological traps out there is something called student syndrome. And you know this one from school, right? You get an entire semester to write a big paper. But when do you actually start working on it? The night before it's due, of course. Well, in investing, that habit is absolutely disastrous. It's waiting until the market is already crashing to start thinking about your risk management strategy. And by then, it is way, way too late.
So, how do we get better? How do we improve? We do it by embracing this simple but incredibly powerful formula. Pain plus reflection equals progress. Look, everyone experiences pain in the market. Losses, mistakes, bad calls, it's going to happen. The key isn't to avoid the pain. It's to reflect on it. Every single mistake is a tuition payment for a lesson. It's an opportunity to refine your process for next time. So here are 4 simple rules you can use for mastering that inner game. Number 1, focus on your process, not the daily noise of the market. 2, make your big decisions when the market is closed, when you're calm and rational. 3, always remember you are buying a piece of a business, not just a ticker symbol. And 4, you have to accept that failure is just part of the journey. It's not the end. It's a lesson that's going to fuel your future victories. And that brings us to our final section, where we're going to pull all of these ideas together into one single, unifying goal, building an anti-fragile financial future. Now, this goes way beyond just being resilient or tough. It's a totally different way of positioning yourself for a world that's filled with uncertainty.
The term anti-fragile comes from the writer Nassim Taleb, and it describes a system that actually gains from disorder. Think about it. A glass vase is fragile. You drop it, it shatters. A steel beam is robust. It can take a hit. But an anti-fragile system gets stronger from stress, kind of like our immune system does after it fights off a virus. For a portfolio, this means being set up to not just survive chaos, but to actually profit from it.
So what does this actually look like in practice? Well, a fragile portfolio is our turkey. It's concentrated, it's unprotected. But an anti-fragile portfolio is totally different. It's structured more like a barbell. On one side, you have the vast majority, maybe 90%, in ultra-safe assets, think cash or short-term treasuries, just sitting there, waiting for a crisis to create opportunities. And then on the other side, you use a tiny portion, maybe 10%, to make a bunch of small, high-risk, high-upside bets, like buying those cheap options we talked about. When a black swan event hits, your safe stuff is protected, and just one of those small bets could pay off 100 to 1, making your entire portfolio stronger because of the shock.
And so that is the question I want to leave you with today. Take a real, hard look at your own financial life. Have you built a system that's ready for the unexpected? A system that can actually get stronger from chaos? Or are you the turkey, feeling safer and safer every single day, completely unaware that Thanksgiving is just around the corner? The choice ultimately is yours.